Hey guys, welcome back. In today's video, we are talking about shorts unwinding, $184 per share, Michael Burry expecting short squeeze, and many more in this video. First, we're taking a look at this. Record-breaking box office, record-breaking concessions, record-breaking Monday, new popcorn pass, not one thing listed under AMC stock news. So this was a previous picture in terms of talking about AMC's performance and its news that people should look out for. And we had so many things obviously happening, especially with some of the recent movies, Wicked for Good, Zootopia, all of these movies, yet we're not seeing how they're trying to correlate that with AMC. Now, if you were to search AMC news, and that's something I just did before starting this video, you will find news on the new popcorn pass now, but the fact is only news on this popcorn pass and not how the box office is doing and how AMC is capitalizing off that. I think it really says a lot about how scared these articles, these institutions, these companies are afraid to let people know what's actually happening with AMC. They are afraid to let people know the truth, to realize that AMC is finally showing why they deserve to be the number one within this industry. And especially the fact that they are benefiting off all of this, that's what's get them to be scared. And the reason why I say that is because of understanding how even small increments of increase for AMC will be extremely strong. Because if you take a look at this, fun fact, if AMC were to move plus 1.77% every trading day for the coming year, AMC will be at $184 per share. But who knows, there might be a quicker path to that level, and UBS recent acquisition of 23 million shares might have something to do with that path. And so I'm sure by now everyone should understand what compound interest is, or at least if you're watching the video about stocks and finance, you will know what compound interest is. And it obviously works in the same way, where if we were to see AMC go up 1.77%, you can easily see that it can go to $184, but that's to assume it's only going up 1.77%. Now, in today's day and age, especially with the current market, with how the box office is improving, with how volatile the market is, and people wanting to move their investment into a safer space that is still projecting growth, AMC, along with the theater industry, is where these institutions and these capital are looking at. This isn't something that is said by me. We've shown you guys data and articles and just multiple things that have shown why the movie industry is recession proof as opposed to all of these other industries. And when you look into these industries, some of the ones that are not only extremely undervalued, but obviously operating well as well, is of course AMC. Not to say that others aren't, but when we talk about in terms of undervalue, when we talk about in terms of improvements, AMC is definitely at the forefront. And so at times like this, it wouldn't be unusual for AMC to see green every day, let alone 1.77%. Now, of course, there will be difficulties. The biggest difficulty will be the fact of the use of dark pool, because we know that AMC should be seeing greens every day until they get to a sensible price discovery. This is something we talked about. This isn't me saying that AMC right now without a squeeze should be 100 billion market cap. You obviously got to consider the current market. The reason why we say it can be $100 billion market cap and even higher is because we include the synthetics. But when you just talk about AMC's fundamentals now, we're not saying that AMC should be 100 billion, but we know what its value is. And we know that at its current state, it is extremely undervalued. But the only reason why we haven't seen real price discovery is obviously because of dark pool. But you can see here how easily it is for AMC to get to $184, and why we've said it is very doable because of the current industry. You can see it's laughable when the short and the stock crew are still pushing the bankruptcy narrative. AMC is more efficient than 2019. The movie industry is not slowing down. Our debt is lower. As the revenues are bringing cash flow, my conviction is stronger than ever. I care about the future of the company. And so when you take a look at what we've talked about with the recent articles, now despite the fact we're seeing all of these movies doing extremely well, we're seeing the box office doing extremely well, you're not really seeing much positive news on AMC because people are still focusing on the bankruptcy narrative. Now, this is at a time where AMC has shown no signs of bankruptcy whatsoever. Granted, 5 years ago when AMC was shut down, there was no revenue whatsoever. This was a valid concern. But as of right now, especially seeing how they are operating, and one of the key words is being efficient, we understand that AMC is improving. And so this is why we are not afraid of any bankruptcy articles, is why we know that these articles are solely being produced to scare people into selling AMC and to stay away from AMC. Right now, we're looking at AMC doing extremely well. Their improvements are showing, and that's why we've said that they are extremely undervalued, because we know what's actually happening. You can even see here, what would you do if you inherited an uncoverable short position in AMC? UBS acquired 4% of the AMC float at $3 right before the vote record date, and no on December 10th could possibly mean Chapter 11. Now, what we're looking at is two different things. Firstly, we've talked about this. UBS being the current position they are in right now. We talked about how they've inherited the AMC swaps from Credit Suisse, and these swaps are eating into them. This is why we've seen how UBS have been required to increase their margin requirements. They have been required, to get tighter regulations to make sure that their risk exposure is handled better. All of these things happened after they inherited Credit Suisse, and we knew what took down Credit Suisse was these toxic swaps of AMC and GME. And now for UBS to acquire such a big amount of AMC should show you how they want to protect themselves in this case. Now, another way we can look at it is understand that potentially they may, and at the end of the day, we talked about this, is that short sellers, the ones who are stuck too deep, they can't get out no matter what. Even if they were to buy the AMC shares, unless every retail investor sells their shares, or unless AMC goes bankrupt, they can't get out. They can only mitigate some of the losses, but they can't fully get rid of the losses. And UBS potentially is one of them. And so what we could see them do is obviously make bad decisions now that they've acquired 4%, because they can obviously use it as a way of voting. And so this is something else that we need to also consider. And so this is something that everyone should obviously bear into mind. But we've already talked about this in terms of understanding the fact that if UBS, who is willing to buy so much AMC at a time where they are extremely, unbalanced right now, they're seeing all of these things happening, crumbling down, and they're willing to buy AMC, it just shows that they still value AMC. They still realize the potential of AMC. And you can even see here, UBS credit funds could face 10% write-down due to First Brand, which means that investors in these funds could lose at least 10% of their money. We recently talked about how UBS were liquidating the hedge fund because of the recent risk exposure they put themselves in. And this is why we've talked about how UBS need to carefully watch how they manage risk, because they are not in a position where they can afford to make mistakes anymore. They have to handle their money extremely carefully. They have to make sure that the current investment they are making right now are and will be returning their money because of all the mistakes they've done. And so this really just strengthens why we've said, if UBS is willing to buy into AMC, you should understand why we talked about how AMC is doing extremely well, especially when all of these articles are telling you to stay away, are telling you to sell AMC, yet we're seeing institutions like UBS buying. Another big thing, and this is what we said earlier, back in the 74% range in the dark pools, every time AMC gets momentum, off-exchange volume spikes. Tell me again, this is normal price discovery. And so it's why we've said AMC obviously isn't seeing the real price discovery. This is what we said at the very start. AMC moving 1.77% every day is extremely simple. It's something that is extremely possible. But the reason why we said that it's hard to happen, it's not because of the fact that I don't think it's not worth it, but it's the fact we're facing a 74% off exchange. And so when we see things like this, you should understand why we talk about there is no price discovery. Because if you want to take a look at the comparison, AMC Entertainment, 73% almost. S&P 500, around 47%. Cinemark, 45%. And so if you want to really take a comparison of what's going on, here is where you can see it. And now bear in mind, dark pool, not only is it used to hide buy orders, but it can also be used to hide short orders, which they can then dump later on, which we've seen Genius Group talk about it and is filed in the lawsuit as well. And so this is why we've said, if we're going to be looking at the comparison between AMC and Cinemark, so many factors have to be kept the same. If we were to see Cinemark also at 73%, then you talk about the value comparison, or vice versa. If we were to see AMC Entertainment at 45% as the same as Cinemark, then we can understand the difference. And there's also talk about Cinemark 120% institutional owned, AMC 95% retail owned, right? There are so many differences that are there, so many factors that are there, which is telling us why this price comparison isn't fair, why we are not seeing true price discovery for AMC. The same for GME as well, and something that's extremely suspicious is breaking highly suspicious ETF GMEU has been removed from register after having spent 19 days on the list due to large failures to deliver. And so another ETF, which is used to locate shares of GME, something we've talked about in the past, is of the FTDs. Now, is it off the FTDs list because it was actually settled? Very likely not. We've seen this happen with AMC. We've seen this happen with GME in the past before. But the reason why I find this interesting is because amidst all of this, we have Michael Burry actually making a message. So he goes, remember GME, bet you did not know this. And in which he actually shows a letter between the ones he sent in from his firm, but also a letter he got, or rather an email he got from Keith Gill, which is obviously Roaring Kitty. And they talk about it being devalued. Now, bear in mind, this is something he released very, very recently. And so we need to understand, why he's doing this, especially at a time like this. Firstly, we've known that he is shorting the market right now. So he's going against these big institutions who are hoping the market to go up. But it's because he sees what's going on. Firstly, you can see, let me get this straight. Legendary investor Michael Burry, the big short, is posting about GME again and includes a previous email with Roaring Kitty that references deep value. The timing of his return is extremely peculiar as GameStop stock is currently in the low 20s, which many think is extreme deep value. So this is him really realizing the value there is. And we talked about this. So many institutions, so many capital is flowing into AMC, is flowing into GME because people realize that there is deep value there. People realize not only is it deep value, but because of how undervalued it is compared to the whole market, which obviously translates to deep value. And Michael Burry doing it at times like this should really show you what it means. Because when you see everything that's going on right now, firstly, Michael Burry opened a massive short on NVIDIA. Here's the connection for GME. The collaterals, hedge funds use NVIDIA as prime collateral to borrow shares and short GameStop. The choke point, 92% of NVIDIA's advanced chips are made in Taiwan. The threat, geopolitics are heating up. Now, let's not talk about the politics here, but let's talk about the collateral. Because something that we've understand is how NVIDIA is used as collaterals. And that's something that we know. We've known that these big stocks, one of the ones, something that we've always said as well, is that along those, NVIDIA has been used as collaterals for these big institutions. And it's why we've talked about the correlation. And so not only has Michael Burry took a massive short against NVIDIA, against Palantir, he's now also talking about the deep value there is with GME. So all of this really leads me to believe that he realizes what's going on, and he's definitely expecting a short squeeze, especially when he's shorting the collateral that's used to, the collateral value that's being used to keep AMC and GME down. Another thing to bear in mind is obviously the reverse repo, 2.2 billion, as we've said. It is closing towards zero. You shouldn't be worried about the fluctuation, but you should understand that at 2 billion, we are getting extremely close to zero. It does highlight the illiquidity issue that's in the market. Not only that, stock market could plunge 80%, warns hedge fund legend Mark. And this is something that we've talked about as well. So there are so many things that you need to look out for right now. So many caveats in the market, so many indications that are showing a massive market crash could be happening, and that we could easily see trillions of dollars being evaporated. Bear in mind, these trillions of dollars that are evaporating, remember, this is a zero-sum game. So the very $1 trillion that they've used to suppress AMC, to suppress GME, when these get wiped out from the general market, they're going to be going to stocks like AMC and GME. And so that's why we talk about deep value. That's why we talk about the collaterals. Another big indications, Berkshire Hathaway's cash position is now almost 30% of their total assets. This is a major warning signal. So another big sign, Warren Buffett, but I know we talked about, or at least we should know that he's no longer the CEO, but you should understand their timing on the market. You should still understand his influence within the company, within the market, and for them to be staying away from the market right now, despite how glamorous the market seems, right? Always, these people talking about all of these potential. We're seeing that AI stocks still go up. Despite all of this, they're still holding on to 30% of the cash. That should really just show you what they're waiting for, what they're expecting, and something that we've talked about all the time within the market crash. Then you can see US market liquidity stress is surging again. And a big focus we have on this channel is, of course, the liquidity. The big reason for that is because that's ultimately what's used. That's ultimately the understanding of how they're suppressing AMC, of how they're suppressing GME. And so with all of these factors, you know, looking at this, you then see what's going on. And if you want to look at another reason, we also have the UK borrowing cost fill, and that's because of the current illiquidity issues as well, along with the yen carry trades. And then we're seeing how big Wall Street players reportedly get wiped out in private equity toilet deal. You know, we're seeing so many things happening right now in the market. Like I said, I'm not just showing you one small piece of information and screaming the market is going to crash. Well, and you know, something I want to clarify is that I'm not saying the market is going to crash, you know, very, very soon. You know, it's not going to crash within a day or two. But we're seeing so many signs, so many indications. Wherever it's these, you know, private equity deals going wrong, wherever it's the fact that we're seeing the Bank of England struggle, we're seeing the yen carry trade, we're seeing the liquidity stress, we're seeing Berkshire Hathaway keeping 30% of the cash, the warrants of stock market plunging 80%, reverse repo at 2.2 billion, Michael Burry shorting against the AI market, right? There are so many signs. So it isn't just me showing you one thing, but it's me showing you multiple different factors that are completely unrelated, but it still ties in together in some ways or another. And it's all indicating to one thing, that the market is going to be looking at volatility, very likely massively towards the downside. And if that were to happen, we're obviously going to be understanding how that's going to affect AMC and GME as well. And it's why I said earlier, with how these institutions are looking for a safe haven, and AMC and GME is that safe haven. As always, now this is financial advice, so do take what I say, so make sure you do your own due diligence and research, and I'll catch you guys next time.